Hello, in this course segment, we're going to be talking about the market for inputs of production. So recall that when we think about factors of production, this is reflecting inputs that are used by the firm to produce various goods or services, such as labor, capital, and natural resources. So what we know is that we can use a production function to show the relationship between the quantity of inputs and the total output. So here we can see that the number of inputs that the firm uses is going to tell us and explain the quantity of output that they're able to produce. So what we want to analyze in this segment is how do we determine the amount of inputs that are going to be used in the market. So when we think about a production function, for example, here we have a very simple one. In this example, the firm is using both capital and labor to produce output. If the firm increases its use of capital, it's going to increase its output. If it increases the number of workers it hires, it's also going to increase its output. So when we increase the number of inputs that the firm uses, this is going to translate to an increase in output. Now, what we want to discuss in this segment is where does the demand for factors of production come from? It comes from the firm. And where does the supply of factors of production come from? Well, it comes from the household. And that's what we'll focus our discussion on today. So to start off with, when we think about firms' demand for inputs of production, it's going to be based on what we call derived demand. So in other words, the demand for various factors of production is going to reflect for the firm how many goods or services it can actually sell of the things that it's producing. So if, for example, a firm's good is in very high demand by consumers and a lot of people want to buy it, well, the firm wants to produce more of that good. Therefore, it's going to want to hire more workers and more inputs of production. So when we think about the demand by the firm for inputs of production, we consider it to be derived demand because it's linked directly to the demand by consumers for the good or service that that firm is producing. So to be able to analyze in greater detail the demand for labor, we have to look at a couple of variables. The first is what we call the marginal physical product of labor. So what this is going to reflect is that it's going to show us the changes in quantity produced based on additional workers. The differences in the marginal physical product of labor are going to help reflect and show us why some people may earn more than others. So what we see is that some workers tend to be more productive because of experience, education and training, or access to the latest technology, which will influence their marginal physical product of labor. So when we look at marginal physical product of labor, we're looking at the change in output associated with adding one more worker in the production. So we know that if we increase one of our inputs of production, we're going to increase our output. The marginal physical product of labor is looking at specifically by how much does production increase for one additional worker. So how much more does one worker contribute to overall production? Let's take a look. So here we have a small company that makes toasters. The price of toasters is $10 and each worker is paid $100. The first thing that we want to know is what is the marginal product of labor? Recall that we're going to be looking at this in terms of the change in the quantity produced over the change in labor. So let's take a look. So what we see here is that as the firm hires one additional worker, going from 0 to 1 workers, it is producing 50 more units of output, 50 more toasters. So one worker, one additional worker, going from 0 to 1 is increasing the production by 50 units. When the firm hires an additional second worker, production increases to 90. So that second worker is producing 40 more units of the good. The third worker, on the other hand, is now associated with 120 units of output. So the third worker has increased production by 30 units. The fourth worker increases production by 20 units, 140 minus 120 divided by 4 minus 3. The fifth worker increases production by 10 units, 150 minus 40 divided by 5 minus 4. And the sixth worker does not add anything to production. Though production is still positive, it is no longer, the sixth worker is no longer adding to that production. And we'll explore why this happens in a moment. Let's think about now the value of that added production. So when we look at the value of the marginal product of labor, we want to multiply the marginal product of labor that we just determined by the price of the good. What this is telling us is it's giving us a dollar figure for the contributions that the additional worker adds to the firm in additional production. So if each worker is adding 50, 40, 30, 20, and 10 additional toasters in production, then multiplying by the price of toasters of $10, that tells us that the first worker adds $500 worth of value to the firm. The second worker adds $400 worth of value to the firm. The third worker adds $300 worth of value to the firm because of the additional 30 units that he produces. The fourth worker contributes an additional $200 worth of value to the firm, and the fifth worker contributes $100 worth of value to the firm. Now, recall also that each worker is paid $100 daily. So, with each additional worker, the cost that he contributes to the firm is that he adds to the firm's cost by $100. Because in exchange for his labor and his work that he's doing, the firm has to pay him. So now, when we look at the comparison between the value that each worker contributes to the firm and the cost of hiring that additional worker, we can calculate the marginal profit. So we simply take the value of marginal product minus the wage, and that'll give us the marginal profit. So the first worker contributes $400 to marginal profit, the second $300, the third $200, the fourth $100, and the fifth nothing. So for the fifth worker, what we observe is that the value that he brings to the firm is exactly equal to the cost to the firm of hiring that fifth worker. So what does that tell us in terms of demand for labor? Well, let's think a little bit more about what the value of the marginal product tells us first. The value of the marginal product, as we have said, is the value of that last unit produced by the additional worker. In some ways, in some textbooks, this is also called the marginal revenue product or the marginal value product. In a competitive market where firms are price takers, the marginal revenue product is going to be equal to the price times the marginal product of labor, because the price will reflect marginal revenue. The firm doesn't have price control, so in a perfectly competitive market, all that it can change is the quantity that it's producing. So the marginal revenue is going to reflect the price of the good. Okay, so what does all of this mean for the demand for labor? Well, as you can see here, and this will be 100, okay. With one worker, the value of the marginal product is 500. With two workers, the value of the marginal product is 400. With three workers, the value of the marginal product is 300. With four workers, the value of the marginal product is 200. Those are corresponding to the points that we just saw a moment ago on our table. So now what we see is that the demand for labor is going to be based on the point where the wage rate is equal to the value of the marginal product, reflecting the fifth worker. The value of the marginal product, or the marginal revenue product, is going to be equal to the wage rate of $100 for the fifth worker. At this point, remember, marginal profit is equal to 0. So for the fifth worker, the value that he's bringing in terms of production to the firm is exactly equal to the cost that the firm incurs in hiring him. So the firm is not going to want to hire any more than the fifth worker, and that the firm will be indifferent between hiring the fourth or the fifth worker. So now let's think about shifts in the demand for labor. What are some things that would cause the demand for labor to change? Well, one of the first is a change in the output price. As the price of the good increases, the firm will be able to produce more, and therefore the demand for labor will go up. The value of the marginal product of labor goes up because the price has risen. So therefore, all else equal, this is going to mean that the firm is going to demand more labor. Okay. Another change associated with a shift in demand is technological change. As technology progresses, workers become more and more productive, and therefore the firm needs less labor. So as jobs become automated and firms replace labor with robots or automated production, there's going to be a decrease in the demand for labor. Third, the supply or costs of other factors will cause a shift in the demand. Or the demand for labor. So if other factors become scarce, the firm can produce less overall. So there's going to be less demand for labor. If one of the key factors of production not related to labor becomes unavailable, then the firm cannot produce that good any longer. So it's not going to need the workers to produce the good if it can't get access to the other inputs that it needs. Okay, so now let's think about the supply of labor. As we have mentioned already, the supply of the factors of production come from the household. And we can think about this in terms of our own roles as employees. So when you work at a job, you are essentially offering your labor or supplying your labor to your employer. In exchange, he pays you a wage rate. So as you can see, individual consumers and individual households are the suppliers of labor. So let's see how we can determine the supply of labor. The additional cost that the firm incurs to employ one more unit is called the marginal factor cost. So this is reflecting the change in the total cost associated with hiring one additional worker. So when wages don't change with the number of workers employed, the marginal factor cost, or the additional cost associated with one more worker, is going to be equal to the wage rate. So let's look at an example here. Recall that the wage rate is equal to $100 per worker. So that tells us that the labor cost that the firm faces for each additional worker that it hires is $100. The total additional costs can be shown here. $100 times one worker gives us a cost of $100. 5 workers times $100 in wages costs the firm $500 in total. So what we see is that the marginal factor cost, when we look at the total cost, or the labor costs to the firm, the change in the total cost, divided by the change in the labor, this column, the marginal factor cost, is exactly equal to our wage rate. So what does this tell us? Well, the supply by the household is going to, or the supply of labor by the household is going to reflect the point where the marginal factor cost is equal to the marginal wage rate. So what we can see is that the supply of labor in many ways is associated with the wage rate that the firm pays for the workers. Next, what we want to do is think about factors that would cause shifts in the supply of labor. So what are some things that would cause shifts in the supply of labor? First, a change in the number of workers or the population. The more workers that are interested in a job, the more labor that's available. So an influx of labor would cause a shift in the supply curve. Another factor would be a change in preferences or income. If people have more income, they're going to choose to take more time off and go on vacation. So the supply of labor decreases. If people prefer to buy more goods and services, well, then they need to work for more income. So the supply of labor would go up. As you can see here, we have brought together the supply of labor from the household and the demand by firms. Where supply is equal to demand in the market for labor, we can see that that's the equilibrium point. What we observe is that the marginal factor cost that determines the supply of labor is equal to the value of the marginal product. So in the equilibrium point, what we observe is that where the supply of labor meets the demand for labor corresponds to the point where the value that each of those workers brings to the firm is equal to the marginal factor cost. And it's equal to the wage rate. So the equilibrium point helps us determine the wage rate that firms pay for their workers. So what can we see in linkages among factors of production? Well, sometimes factors of production are used together. The productivity of each factor depends on the quantities of the other factors available. If there's a change in the supply of one of the factors, that can change the earnings of all of the other factors. When we see a change in the earnings of any of the factors, that can be found by measuring the impact of the event of the marginal product on that factor. So what have we learned in this segment of the course? Well, we've seen that the demand for labor, the demand for inputs of production in general, are reflecting not only the value that each additional worker, each additional input brings to production, but also the cost associated with hiring one more input of production. On the supply side, the supply of labor, the supply of inputs, is based on the marginal factor cost. So what we see is that many times the marginal factor cost is actually equal to the wage rate. And this is true especially if, and particularly if, the wage rate does not change with more workers being hired. So if all workers are charged at the same or paid the same wage rate, then the marginal factor cost reflects the wage rate. So when we bring supply and demand together, the equilibrium point is going to determine the wage rate, which is based on the marginal factor costs and the value of the marginal product of labor. Thanks so much for joining me in this segment on inputs of production.